18 minutes past the hour. Let's get a tech check with Deirdre Bosa. Hi, Deirdre.
Hey, guys, you teed it up perfectly before the break. The startup world is supposed to be high risk, high reward, but it has certainly changed amid rising interest rates. And the kind of deals getting done has changed, too. And today, maybe in a sign of the times, a startup getting funded is not promising to change the world. It's just helping tech companies invest in boring treasuries, or maybe we should say relatively boring treasuries. Zamp Finance, it is a treasury management platform that partners with BNY Mellon to allow companies to invest surplus cash in U.S. Treasury bills and notes, essentially acting as a corporate treasurer, letting the startup focus on what it does best, its core operations. Now, here's why that's interesting. The implosion of SVB Bank was a wake-up call. Yes, startups, they need to innovate and disrupt, but it's also now clear that they need to think about protecting their cash against bank failures and other uncertainties. So who is backing this startup? Maybe even more interesting. Zamp's latest $20 million round had participation from the CEOs of Uber and DoorDash, as well as Marcelo Claure, key architect of SoftBank's Vision Fund, and a former executive chairman of WeWork. In other words, these are the people who have run some of the most unprofitable tech companies or funds in recent years. They're kind of the poster children of high risk, high reward. The idea that the executives that ran these companies and funds during that low interest rate boom times, that they're now bullish on treasury management, really underlines 2023 as the era of conservative spending and cost cutting. Meanwhile, guys, another indication of the age of austerity for even the profitable mega cap tech companies. Google also still cutting, but just around the edges. Snack bars and staplers are the latest under pressure. I don't know if you saw, we have it here, Jen Elias's latest article, but even staplers, guys, are getting cut out.
Take away my coffee. Take away my desk lamp. But leave my stapler. You will pry it from my cold, dead hands.
It just reminds me of that.
Charlton Heston once said.
Remember that movie Office Space where the guy's going around and he's like, but my stapler. Who's got my stapler? Did you take my...
I mean, that's what the stapler.
That's going to be it at Google, right? That if you are cutting down on staplers, everybody's going to be searching for them. I wonder if that's going to be a problem for team morale.
Staplers.
Well, you could argue that maybe the masseuses that were cut in the last round is worse for team morale. But in all seriousness, guys, I mean, that is serious. The masseuses were cut. But in all seriousness, yes, team morale. On the other hand, though, I mean, Google has done less cuts than some of the other big tech companies. So while you may lose your stapler and your snack bar and your lunchtime masseuse, you might still have a job, right? Analysts, Wall Street, often say that maybe they should be cutting more. So
back to your first topic, which was the use of T-bills as a place for cash for corporate treasuries. And I understand it. I mean, I understand the idea that these companies are afraid that they may fall victim to a bank issue like Silicon Valley Bank. At the same time, they most certainly have fallen victim to the idea that bankers don't want to pay much on deposits at all. And so they're going out into the Treasury market where they can get 4% or more on their idle cash.
That's a great point, because even if you're not worried about a bank run or a bank failure, this whole episode has taught these startups, okay, they're parking millions of dollars in most cases for seed rounds, latest fundraising rounds in the bank. And if you're not earning anything on that, why not put it in a short-term T-bill, right? So there was sort of this financial literacy here in the Valley. Proper cash management, that's what this company does. Says you as the founder, you don't have to worry about it. Just worry on the disruption or whatever you're trying to create. Let us handle sort of these short-term investments, so at least you're earning something.